Good morning, everybody, and welcome to this webinar. Now, it's the last webinar in a series of webinars for the education sector, and today we're looking at the 3 new accounting standards for the education sector. And I've said the clock is ticking down because these 3 new accounting standards are applicable on or after 1 January 2019. And that is just after Christmas, and Christmas is just around the corner. So if you haven't met me before, my name is Aletta Boshoff, and I'm a partner and national leader within IFRS Advisory in BDO. And we've got a nice big team who all work in this space. And I hope you find this webinar informative, and welcome to the webinar. If you look on the right-hand side, you should see handouts available. Now, I've saved a PDF of the slides and I've put it in that handout block. So if you go there, you should be able to download the PDF of the PowerPoint slides. Also on the right-hand side, there's a place to put in questions, and there's also a chat room if you want to speak to each other. So usually the questions is questions to the presenter, and the chat room, everybody speaking to each other. So that's maybe the logistics for today. And as always, we'll send you the slides and a link to the recording after the webinar as well. A bit of an introduction. What are we going to cover in this webinar? First of all, the 1st of January really is that big date for not-for-profit entities. So our for-profit entities, their big date was the 1st of January 2018, and they had to adopt 3 standards. And the only standard that they're still waiting to adopt basically is the Leases standard, because the date for the Leases standard is also 1 January 2019. I'll look at AASB 15 today, revenue from contracts with customers. I'll also look at AASB 1058, income of not-for-profit entities. I'll look at leases, and I'll specifically refer to peppercorn leases because our not-for-profit clients are really concerned about the impact of these peppercorn leases. We'll talk about next steps, and there's also a general question, do you need assistance? And I try and highlight some areas where you can find assistance, publications, maybe recorded webinars, the AASB website, so a number of places that you can get a bit of assistance. I should also say that the AASB staff and BDO have worked together to create some not-for-profit frequently asked questions. And the focus of those are actually AASB 15, 1058 and 16, the ones we'll discuss today. It's an ongoing project with the AASB staff. I think the staff about a month ago, they released on the AASB website the first frequently asked questions that we worked on. And I'll give you a link to that later. And we're continuing to work on a number of others as well. So just keep an eye out for that as well to help you. So 1 January 2019, the clock is ticking down really fast. It's September already. So for not-for-profit entities, in this wave of changes, and it's actually more a tsunami than just a wave, there were 4 big standards. And you'll see AASB 9 financial instruments, not-for-profits would have already implemented, and therefore we're not discussing that today. The 3 that we discussed today are the 3 new ones. So the 3 ones that are coming is AASB 15, 16 and 1058. Now all 3 of them are effective for years beginning on or after 1 January 2019. So if your entity have a 31 December year end, you have to be ready when you do your financial statements 31 December 2019. Basically, you genuinely have to be ready 1 January 2019. And for 30 June year ends, we are talking 30 June 2020. So you've got another 6 months. You only have to be ready 1 July next year. But it's only 6 months, and it goes really fast. So that's just, when these become effective. You might say, why are we talking about it now? I mean, today we're in September. If you've got a December year end, you're already in your comparative year. So if you prepare your 31 December 2019 financials, in that period, 1 January 2019 to 31 December 2019 will be your current year. And your comparative year, we're already in that comparative year. And if you've got a 30 June year end, again, you're already in that comparative year, because your 30 June 2020 financials, the comparative year will be 30 June 2019, and we've already started that. So it's really important for us to look at this as soon as possible, because this is important, it's imminent. Now, transitioning to these three standards, I thought I should ask a few questions and we'll come back to them at the end of the session. When you transition to these standards, all three of them, I suppose my first question would have been, have you educated yourself and your team about the technical requirements of these three new accounting standards? Because that would be the starting point, to educate the team, to know what the technical requirements are. The second thing is, have you done a risk assessment about each of these standards? So now that you know what the technical requirements are, have you gone through a structured process where you've done a risk assessment on how that standard will impact your organization? The third one is, have you designed an appropriate response to that completed risk assessment? And you have to do it for each standard. And I truly believe it has to be a structured approach for each standard. There's so much detail in these standards. If it's not a structured approach, you might miss things. The fourth one is, have you designed a project plan to implement these standards? So a lot of clients that we're speaking to have a project team or have a project plan, even if it's just one or two people, how they're going to roll this out. Another very important thing is, have you decided on an appropriate transitional approach? Now, each of these three standards, scarily enough, have their own transitional approach, and AASB 16 specifically has three different transitional approaches. And it's important that you pick the right one, because each one of them have certain pros and cons, and it depends on what your needs are and how it would impact your numbers, on which would be the best transitional approach. And I'll talk about that later during the webinar and give you some guidance on what I see clients do. And then the last question is, have you changed or improved your systems, your processes to deal with the standards? It's not necessarily IT systems and processes. It could be manual systems and processes, but have you thought how to change those to deal with these accounting standards? So I think these are the hard questions that we have to ask each other so close to the date of initial application, which is 1 January or 1 July for most of our entities in Australia. So let's take a step back. That's a few, let's say, thought-provoking questions at the start. If we go back and we look at AASB 15, revenue from contracts with customers, first of all, I think one should say, when would AASB 15 apply to not-for-profit entities? Because from an income recognition perspective, you've got two potential standards for not-for-profits. You're either going to apply AASB 15 or you're going to apply AASB 1058. Now, I know when speaking to not-for-profit clients, everybody would love to apply AASB 15 because it could potentially get to a very old-fashioned, out-of-date term called matching. Because as you satisfy performance obligations, you would recognize your income, and as you satisfy performance obligations, you usually incur expenses. So there could be some level of matching happening if you can get to AASB 15. It's not easy to get to AASB 15 though. You have to jump 2 hurdles. The first one is, does this transaction occur in a contract with a customer? So, a different way to put it, does the transaction occur in an agreement with another party that creates enforceable rights and obligations? Now, AASB 15 and 1058 go on extensively on when do we create enforceable rights and obligations. But that is the first threshold hurdle that you have to achieve. Are there enforceable rights and obligations? Now, the easiest ways, I suppose, to get there is to say if I don't spend the money that I've received for a particular purpose, I have to repay it to the person who gave me the money. That's the easiest one. But there are a lot of other alternatives, and I know we've had a webinar earlier in the series that looked at that. The second hurdle to jump, if you could get over the first one, is does the contract include sufficiently specific performance obligations? And this is an important one because only if we've got sufficiently specific performance obligations that the entity can measure progress and can measure to what extent they've actually transferred the goods or the services to the customer, so the entity can measure to what extent they've performed, can you apply AASB 15? If you cannot measure it, if your performance obligations are not sufficiently specific, you're outside the scope of AASB 15. You're actually in the scope of AASB 1058. Which has, I would say, a general foundation that if you get this money, there's no enforceable rights and obligations, there's no sufficiently specific performance obligation, you often recognize it when you receive the money. So you don't get to the nice matching, which a lot of, you won't get to the place that you potentially want to be. So that's a little bit of an introduction. When does AASB 15 apply? I just wanted to flag that 15 would not apply to each and every contract and every situation. I think the other thing that's important to say at this stage, some of the clients, when I've been speaking to them, have this idea that they could holistically, for their not-for-profit entity, decide whether to apply AASB 15 or AASB 1058, and you can't. You have to do this assessment, whether to apply 15 or 1058, on a contract-by-contract basis. So your accounting policy would have to deal with both. Your accounting policy will have to start with, whenever I receive money and whenever I have these contracts, the first step is to consider whether I'm within AASB 15 or 1058. If I'm in 15, this is my accounting policy according to 15. If I'm in 1058, this is my accounting policy. So it's important to realize that you have to look at it on a contract by contract basis. Now, that kind of gets me to the point that, do you know how many different contracts do you have within your organization? So how many different contracts do you have to get government grants, to get bequests, endowments, etc.? Because for each one of them, you have to make an assessment, whether it's 15 or 1058, and then apply those standards. So that's important as a starting point, at least to know how many contracts you have that have to be assessed. And if there are 20 contracts that are the same or similar, are you sure they're the same or similar? Can we assess one to be then representative of all of them? So that is a very important decision for you to make. Now, if you apply AASB 15, the core principle is that you recognize revenue to depict the transfer of promised goods or services to customers in an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods or services. So basically, you're going to recognize your revenue as you satisfy your performance obligations. And if you satisfy your performance obligations over time, you would recognize your revenue over time, potentially. So there's a number of steps that you have to work through to get to the answer. The core principle is a nice sentence, but not necessarily workable. it is important to know whether you've got a customer, and there's also a discussion in the AASB materials around what would a customer be in a not-for-profit context. So the customer doesn't have to be the person who gave you the money. If the government gives you a money to provide a service to children, then you don't have to say, listen, I'm not providing a service to the government, and therefore I don't have a customer, I don't apply the standard. So it's important to look at that definition of customer and how it applies to not-for-profit entities. If you look at the 5 steps to apply the core principle, so, to execute the core principle, we have to identify the contracts with the customer. So if the customer has asked me to do certain things on their behalf, they're still a customer. As long as there are enforceable rights and obligations to somebody, I've got a customer. So, it's a different interpretation to we have in the for-profit world. And I also have there identify the contracts with the customer. So often with not-for-profit entities, I'm finding that I look at a contract that they want me to assess, and in that contract, the contract refers to other contracts, sometimes 5, 6 other contracts. It refers to government legislation, which I usually can access via the website, etc. You cannot look at a contract in isolation. It's extremely important that you identify all the related and linked contracts and determine the accounting treatment of the linked contracts. And you would link these contracts when it's impossible to understand the commercial reality if you don't understand the bigger picture and look at all the contracts. Your second step is to identify the separate performance obligations. So in simple English, what have I promised to do? What goods have I promised to deliver? What services have I promised to deliver? And so that's step 2. What are the separate performance obligations? In step 3, determine the total transaction price. So that is all of these contracts together. If I look at them all together and I look at all my performance obligations in all these contracts, what is the transaction price that I'm going to get, the total amount? And then in step 4, we allocate that total amount that we've determined in step 3 over all our promises that we've identified in step 2. And then in step 5, we finally recognize revenue when a performance obligation is satisfied. And there are a lot of rules on whether performance obligations are satisfied at a point in time or over time. And that's an important aspect to go through. So at this stage, I thought I don't want to work through any further details around the steps. I can refer you to 3, 4, 5 webinars I've done over the last 2 years around the steps in AASB 15. And I know there was an education specific one earlier in the year, which I think Kevin Frobers, my colleague in IFRS Advisory, presented. So I think you've got a lot of that. I thought I'll just do a little bit of revision on what that would mean for the education sector potentially. So I've used examples that I've extracted from the AASB illustrative examples. I've changed them slightly, tried to shorten them slightly to potentially make sense within an hour that we have. So on 30 June 2018, an alumnus transferred $2 million in cash to University A as an endowment. And under the terms of this endowment, the $2 million cash can be invested at the university's discretion. And University A is required to provide a annual scholarship or the annual scholarship for one student's accommodation for a defined period of 30 years. Now, let's assume that the expected cost of that annual scholarship for that one student for the 30 years is 1.85 million. Now, if the university breaches the terms of this endowment, the university is required to return the real value of the principal to the alumnus. Now, the entity's reporting date is 30 June. So what's happening is we get all this cash, $2 million cash on 30 June. We have to prepare our financials at 30 June 2018. What do we do with the 2 million? We know we're going to spend this 2 million over the next 30 years. So it's been dedicated for a particular purpose. So which standard do we apply and what are the resulting journals? So in this situation, there's two hurdles to jump in order to get into AASB 15. And as we said, the first hurdle is the enforceable right. And I would say yes, because I have to repay it if I don't do the right thing, if I don't spend the money on a student's accommodation. And the second thing is, do we have sufficiently specific performance obligations? Now, I would argue yes. I've got this one student, I have to pay it for 30 years. We can come up with a cost of what an annual scholarship would be. And therefore, as soon as I can say, listen, I've now provided the accommodation, I've paid for it for this student for this particular year, it's sufficiently specific. I think what's important is they have said to just say you have to spend this money over the next 30 years is not sufficiently specific. Just by adding a time period doesn't make it sufficiently specific. There has to be something else. So it is for a student, it's for accommodation, so we know exactly what we have to do. Therefore, in this situation, on the 30th of June, when we receive the 2 million, um, I would think that we would say debit cash, the 2 million, credit a liability for the 1.85 because I either have to spend it on a student's accommodation over 30 years or I have to repay it. And the other amount, I would say credit income immediately. They've given me 2 million. My contract liability is 1.85. So the other 150 is not linked to sufficient specific activities. It's therefore more akin to a donation, and I book the income up front. And then at 30 June 2019, I would say, listen, the 1.85, let's assume it's an even expense over the 30 years. I appreciate that it often isn't, and that it will get more expensive, etc. But let's keep the modeling very simple for my example. Every year you would say debit your contract liability and credit income, the 61667. So obviously, you'll have to come up with what is your expected cost for this one student's accommodation over 30 years. If there was a bit of science to it, maybe the 2 million would line up with the cost of 2 million. Or maybe not. But this is just an idea. But you can see by this example, it is very subjective. To look at the numbers, but the first part even is subjective. Do we have an enforceable right and obligation? Yes, we have to repay. The second one, is it sufficiently specific? I know when BDO worked with the AASB staff on frequently asked questions for not-for-profit entities, we've put around 15 different frequently asked questions to them and say, could you please help us just around sufficiently specific performance obligations? Because in our client base, we've seen that is the area that is really judgmental. And they still, the AASB staff are still considering those and working on those. And I'm actually quite keen to see what they end up with. We've made some recommendations, what we think, but ultimately it's not our decision, and it's for them to come up with something that they're happy to put in a frequently asked question on the AASB's website. So keep an eye out for that. But this is one example. Another example is, let's say you receive a multi-year cash grant. So here I've said the local government enters into an agreement with the state government in the form of a memorandum of understanding to receive a multi-year cash grant of $90,000 from the state government, and it's received in full on the 24th of June 2018. Now, the grant is to fund education programs over 3 years commencing 1 July 2018 with the objective of increasing the literacy of students of a specific rural area. Now, the Memorandum of Understanding outlines the agreed activities of the education programs. that are tailored to the literacy needs of these students, and the local government is able to identify when its specific performance obligations are satisfied and expects to fulfill its promise to provide the agreed activities. So you can see all of this third bullet point is around, do we have sufficiently specific performance obligations? You know, is there some clear understanding on exactly what we have to do over the 3 years? We cannot just say in bullet point 2, spend this money over 3 years and increase literacy. That's too vague. So in the third bullet point, we try and narrow it down. We've got agreed activities, whatever they may be. It specifically will be running at certain dates, certain times, certain number of students potentially, and certain outcomes. Now, the state government can enforce the repayment of the grant if the specified activities are not undertaken, by requiring direct repayment, um, or otherwise deducting unspent money from future funding. So, to deduct unspent money, all of this is aimed at these enforceable rights and obligations. Now, again, the entity's reporting date is 30 June. Now, I've tried to make it clear in this example that I think we've got enforceable rights and obligations, because if we don't spend the money on these literacy programs, we have to repay it. And then the second hurdle, I've tried to make it specific. I haven't given you the details, but I've said, listen, it's very specific on what we have to do, what programs, how many people, how many locations, etc. And so we can measure progress, to what extent we've done it. So it's not just over time. And then I've said the journal entry at the 24th of June, when we receive it, we debit cash 90,000, we credit a contract liability. And then I said a year later, and I've just kept it even, I said over 3 years to make it simple. But I've assumed, therefore, that we've got all these activities, all these programs, etc., in great detail, and we're going to run them evenly over the 3 years. And actually, by 30 June, we can see that we have run a third of the program as required in that particular year. And therefore we recognize income of 30,000. And on the assumption that we continue to do the right thing, run the activities and the programs as agreed, over the next 2 years, we will recognize income every year. And that's where you can see this potential sum, I would put in inverted commas, matching between the income we recognize and the money we've spent to run these programs. But it's not easy to get here. What I wanted to add today, a little bit more flavor, is this whole transitioning thing. Sorry, just a sip of water. There are two options available when you transition to SS B15. And I should say it's very important to understand the nuances. There's the retrospective method, so that's full retrospective. So you have to apply the new standard in the current year, the first year that you're applying the standard. So let's say 31 December 2019. You also have to apply to the comparative year and all previous years. So what's important is, under both options, you actually apply the standard retrospectively. The calculations are applied retrospectively. The question between these two methods is, how do we disclose the impact? Retrospective method only means you disclose the impact in the current year. You do the calculations back in history. Cumulative effect method is retrospective method, I do apologize. Retrospective method, you do the calculations back in history and you fix the current year and the comparative year, and you fix the retained earnings opening balance at the beginning of the comparative year. So you do retrospective disclosure as well. Cumulative effect method, you do your calculations back in history, the same as retrospective method. However, you decide to disclose it cumulatively only in the first year of adoption. So the options available are disclosure options that are available. It's not calculation options. The calculation options for both are the same. With the exception of the very last bit that you see on this slide, and that is for the retrospective method, you've got a choice of 4 practical expedients that you could use. So if you want to do full retrospective disclosure, there are 4 practical expedients that you can use to make it easier. And if you use the cumulative effect method, so you're only going to look at your current year, disclosure in the current year, you've got 1 practical expedient that is available. So it's important to decide which one you want to use. So if you look at the practical expedients, 4 practical expedients that you can decide to use or not, and you could apply practical expedient 1 and 3, or you could apply practical expedient 2, or you could apply all 4, or you could ignore all 4. So it's important to look at these practical expedients and determine which one do you want to apply and whether that one is available for your selected transitional approach. I suppose some key concepts that you'll hear throughout when we talk about transition would be around date of initial application. So 1 January 2019 if you've got a 31 December year end, or 1 July 2019 if you've got a 30 June year end. When you look at completed contracts, where contracts have performed completely in terms of AASB 118, so you've started with a contract in 2011 and you've completed it by 2014. I mean, that's a completed contract. You've accounted for it in terms of 118. It is before we start looking at transitioning to 15. We're not going to reopen that. Even if we reopen it, it's all going to be an opening retained earnings anyway. I tried to give you an example of transitioning to AASB 15 just to illustrate the 2 transition methods, which are really a disclosure thing, as I said. Now, you don't have information at the back of this to help you. I would say it's loosely based on the example 2 that we've just done. I just try and illustrate the difference between the 2 approaches. So what I've said, and let's just assume the information, I said in the first row, the income that you've recognized under the old AASB 118 or AASB 1004, and at this stage we don't really worry which one you've used, you would have used, let's say, 30 June 2018. If you applied the old standards, you would have booked income of 90,000. And then for 2019, nothing, 2020, nothing. However, let's assume that you now recognize income under the new AASB 15. Let's assume that. And therefore, under this new revenue recognition or income recognition, although you received cash in the 30 June 2018 financial year of 90,000, you didn't book any income. You're now going to book 30,000 in 2019 and 30,000 in 2020. So that's just the numbers, how the numbers are changing. So now the question is, how are we going to disclose it? So this is a disclosure issue. If it's the full retrospective method, in your 2020 financials, you will have income recognized of 30, and you will have income recognized of 30 in your 2019 financials, because you're going to fix the current year and you're going to fix the comparative year. The other thing that you will then have to do is whatever income was booked in 2018, you will have to remove in the opening retained earnings at the beginning of your comparative year. And that's where it will be disclosed in the statement of changes in equity. However, if you've used the modified retrospective or the cumulative retrospective method, you would have only fixed the current year. And the comparative year, you would have kept the old numbers. So the old numbers in the comparative year were 0. You'll keep it as 0. You're not going to redo the 2018 financial, so it's not applicable. So the question is, how do we adopt the new standard and disclose it just in the current year? And what you're going to do is you're going to say income recognized should be 30,000 in the current year. And by the way, I'll also have to fix opening retained earnings in the current year. But now to fix opening retained earnings at the beginning of the current year will only be a deduction of 60. And if you look at the cumulative effect of the retrospective method, it's just disclosed in the 30 June 2020 numbers. So it's a difference between the 30 and the 90. So what I want to show you here is the calculations and the level of detail required for both transitional methods are really the same. It's just the disclosure in your financials that are different. The only thing that would make your calculations easier is if you use those practical expedients, one or more practical expedients. So I think that's an important message that we have to get out. If you look at the journal, so the journal entry on the 1st of July 2019, your date of initial application, and this is important for both alternatives. Doesn't matter how you disclose it. This will be your journal on the 1st of July 2019. Debit retained earnings opening balance 60,000, credit income 30,000 in that year, and credit contract liability 30,000. So it's really important that we understand that the journal doesn't change, but the disclosure will change. All right. Transition to AASB 15. So there's things to consider. The cumulative effect method could potentially be less effort because you don't have to worry about the disclosures. Potentially requires less information. I'll be a bit careful. The comparative figures are actually unchanged when you disclose it. It does impair your comparability in the prior year, and it often obscures trends and variance analysis. Your retrospective method allows for you to use more practical expedients. That's why I'm saying I'm not sure the cumulative effect method is always less effort, less information. It depends on which practical expedients you use. It does provide more relevant and comparable information. So it depends on what you want to achieve, which method you're going to use. And it very much depends on which contracts you have in place. So that's AASB 15. If I move on to AASB 1058, just a reminder, when would you use AASB 1058? And it's the same decision tree we've used earlier. If you can't jump these hurdles to get to AASB 15, you end up with AASB 1058. Now, 1058 has a general overall scope that it applies to volunteer services, or it applies to transactions where the consideration to acquire an asset is significantly less than the fair value, and the reason people are giving you this asset or this money at less than fair value is they want to further the objectives of the not-for-profit entity. That's the reason they give you the money. Otherwise, they would have given you something at fair value. The overall principle, and I know Kevin discussed this in earlier webinar, is you always start at the asset side. Debit the asset, whichever asset it is. It can be cash, it can be shares, it can be property, plant, and equipment. It can be various things. Apply the appropriate standard. So start with, what do I debit? Then what do I credit? So are there any other standards that's addressing the credit? So is this a contribution by equity holders? Is this a liability that I have to book in terms of AASB 15, a contract liability? So look for the credit in your other accounting standards, and only if you've got something left. So the excess of A over B will immediately be recognized in profit or loss. So an example, and I'm going back to an example that we've used earlier today, and I've tweaked it a little bit. Again, a multi-year cash grant. So the local government entered into an agreement with state government to receive a multi-year grant of $90,000, and it's received in full on the 24th of June 2018. Now, the grant is to fund education programs over 3 years, commencing the 1st of July 2018, and the objective to increase literacy of students. Now, the Memorandum of Understanding does not specify the specific activities that the grant must be used for. It's just generally to increase literacy of students in this area. And you can see, I've put it in there so you can see it's not sufficiently specific performance obligations, therefore we don't qualify for AASB 15. We do have to repay the grant if we don't do the right thing, and reporting date is 30 June. So very judgmental whether it's sufficiently specific or not. And on the spectrum, when would we tick over to sufficiently specific? My two examples are very clear cut. In the one, there's no guidance, and the other one, very specific activities, number of students, number of programs, etc. But where is the cutoff? Very grey in practice. So in this instance, because it's not sufficiently specific performance obligations, applying AASB 1058, you would say debit cash and credit income 90,000 when you receive it on the 24th of June 2018. So that's just the contrast between 15 and 1058, and the transitional approach for 1058, similar to AASB 15, but there are no practical expedients in 1058. I would like to look at leases, and again, I know Michael has looked at a webinar earlier in the year for the education sector on leases. So I want to focus more on the transitional aspect, because in speaking to clients implementing leases, I found a number of practical problems, and there's a number of business problems actually around IFRS 16 that I want to flag with you. So I'll do a bit of an introduction, and then we'll move on to those more business problems. So the big change is that you will no longer have operating leases. So all operating leases, finance leases, will be treated the same way. It will come on the balance sheet. Now, I'll talk about the biggest issue that I'm finding with clients at the moment, and that is, do you have copies of all your operating leases? Because in the past, operating leases were paid through the creditor system. If I go to clients, they can tell me what their operating lease payment is. They can tell me what their accrual is. Hopefully, they can tell me whether they've got a restoration obligation that they've booked separately as a liability and a leasehold improvement. But if I say, okay, I need more information than that to apply IFRS 16 or AASB 16, I now need a lot more information, not just the payment amount that you pay every month. They don't have that on a system. But that's okay. So, okay, give us the lease contract so we can extract it from the operating leases and put it in a system for you. And that often is where it falls down. So do you know how many operating leases you have? Do you have the actual agreements to support those operating leases, including all your peppercorn leases? So that's question one, business problem. So it's the end of the road for operating leases. They will be treated the same as finance leases on the balance sheet. I've done a simple example. Let's say I lease a building. I've got my payment structured over 3 years. I pay it in advance. My incremental borrowing rate is 10%. So how would I do the calculations? Currently, you would work out an even expense is $72,000. In your profit and loss every year, you'll see the $72,000. In year one, you'll book an accrual. In year two, that accrual will stay. In year three, the accrual will reverse out. Under AASB 16, we now have to do an amortization table. Now, for this one, the amortization table is very simple because it's 3 years, end of story. However, I would ask, if you've got leases, do you have options to extend? Are you reasonably certain to extend, yes or no? For how long can you extend? Because if you've got a 3-year property lease, but you've got an option to extend for another 3 years, and you think you are going to extend because it's a very good location, very good price, peppercorn lease, you're going to extend, then it's reasonably certain, and therefore your lease period is now 6 years, not 3 years. And it can have a big impact on the numbers. So in my simple example, the impact on expense is currently you've got an even expense, and going forward your expense will be front loaded because you'll have a higher interest expense at the start of a lease than the end of the lease. So you're not going to have an even impact on profit and loss. So as a not-for-profit entity, now, if you do budgeting or forecasting, have you factored in what your expense will look like over the next 10 years based on your existing leases? If you look at your statement of financial position, you're going to have a right of use asset, which is a non-current asset. You're also going to have liabilities. They're not always going to match the right of use asset, because the right of use asset is depreciated evenly, but the liability is repaid slower at the start due to the higher interest expense. And also, and this is the big bummer, is that you have current liabilities because you've got commitments to pay within the next 12 months. So there's change in your current liabilities, but there's no change in current assets. There's also change in non-current liabilities, but that's a lot less than the increase in your non-current assets. So your problem is around your current assets / liabilities. So if you look at net current assets, that is really going down. And net assets liabilities also going down, but the issue is usually for our clients around net current assets, and usually because there's some sensitivity around that number due to bank covenants. Now, if you don't have bank covenants, but you get government funding and government has put certain KPIs in place for you, or if your users are interested in that net current asset number, this can have a big impact on you as well. Again, it's a business problem. Impact on cash flow. The cash flow stays the same, but where you disclose it in the cash flow statement changes. Currently, it's just an operating cash flow. Going forward, the repayment of the lease, the capital part is financing, and your interest expense is financing or operating based on your accounting policy. Now, things to think of, and this is more the business aspects, is what is the impact on your financials in future, and how do you communicate that to your board and your stakeholders and your users, whoever they may be, government, donors, etc. What are your key ratios, and what would this Leases standard do to your key ratios? What are your KPIs, and what would the Leases standard do to your KPIs? Therefore, is it profit volatility? Is it net current assets? EBITDA actually is increasing. I don't think not-for-profits would usually focus on that. If you focus on that, it's increasing. Bank covenants could be a problem. Not-for-profits don't declare dividends, but that's a real big issue for a lot of our for-profit clients. An interest rate cover, a debt equity ratio. What are the ratios that you are particularly worried about? And then what does IFRS 16 do to it? The peppercorn leases is making things worse in that currently when I speak to clients, peppercorn leases, it's dollar. And some of these leases I've looked at actually says a peppercorn. So there's no journal entry for the dollar or the peppercorn usually, but we're using the property. And therefore, there was no real reason to keep contracts necessarily, etc. So the new AASB 16 says where the lessee in a peppercorn lease is a not-for-profit entity and the lessee has significant below market terms and conditions. So, it's not just peppercorns, it is anything that is significantly below market terms. So, 2/3 of normal market rentals. And the reason you received it is to enable your entity to further your objectives. The entity shall do the following. They shall measure the right of use asset on day one when they enter into the peppercorn lease at fair value. So they'll say debit right of use asset at fair value. They would say measure the lease liability at the present value of the lease payments. Now, if it's a peppercorn, the present value of the lease payments, so the lease liability is 0, and they will recognize any related items in accordance with AASB 1058, which would often be credit income, because you're leasing a property, for example, for $1, and the lease doesn't tell you what to do with the property. Are there sufficiently specific performance obligations? Now, if there are sufficiently specific performance obligations and that you will no longer be able to use the property if you're not doing the right things, then potentially we could defer it over the period. But there's a big chance that it could be on day one, AASB 1058, and I've put a question mark there, potentially income day one. Not always. So in my example, I've said, let's say we've got a lease and school A enters a 30-year lease with a lessor for the use of a building. Now, the lease contracts specify lease payments of $100 per year for the 30 years. At the inception of the lease, the entity assesses the terms and conditions of the lease, including restrictions, and determines the fair value of the right to use the facility for the 30 years is actually $360,000. So this is an important point. You don't determine the fair value of the building on day one, inception of the lease. It is the fair value of the right to use the building for 30 years. And if there are restrictions on what you can use the building for, you factor that into coming up with your $360,000. The lease premises must be used to provide education services, or else School A will no longer be able to use the facility. There are no other conditions specified in the lease contract. So you can see if they say, here's a lease, use it for education services. If you don't use it, you have to give it back. So that is an enforceable contract. I'm happy with that. But the second part, do we have sufficiently specific performance obligations? No, because it's just education services in general. It doesn't say exactly what you have to do, how many students, how long, what programs you have to run, etc. So the lease doesn't say that. And let's say the net present value of our lease payments, the $100 per year, discounted at the school's incremental borrowing rate of 5% is 1,537. Let's assume that. What would the journal be when you enter into this peppercorn lease, or this lease of significantly below market terms? You would say debit the right of use asset at the fair value of the right to use the building, $360,000. And remember, now you have to depreciate it over the use. So you've got an extra expense. You've got an extra asset on day one, but you've got an extra expense to put in your forecast and your budget. Credit your lease liability with that 1,537, the net present value of the lease payments of 100, and credit income of the difference, because there are no sufficiently specific performance obligations. So this is one that is really creating havoc for our not-for-profit entities, because they have to come up with the fair value of that right of use asset, and they have to come up, capturing all this information. Now, at BDO, one of our corporate finance partners, or a few of them actually, are working on this, are aware of it. So if you need assistance, you can help you with coming up with a fair value of that right of use asset. The other thing I thought I'll talk about is BDO Lead. Now, BDO Lead is our very own BDO AASB 16 technology solution. So I've given you there the link. I can click on it and see if I can go there quickly enough. Take a sip of water while we wait. And what we've got is we've got a lease management and a AASB 16 calculation tool. There's a demo there that you can watch on how it works, information, and you can contact me if you've got queries. Important about this tool is just saying, if you've got all your lease contracts, we can extract the data, we can put it in this tool. The tool can do all the net present value calculations for you. If corporate finance gives us the fair value of the right of use asset, we can put it in this tool and it can calculate the depreciation. Now, the tool makes sense, I would say, if you've got more than 20 leases that you have to manage, because in this tool, we put all your termination options to extend. The tool can do everything that 16 wants you to do. So, if you're interested in that, you can contact me and we can talk about that. I just wanted to flag, we have a tool that we could use. Transitioning to AASB 16, and this is a really critical thing. Whenever I talk to clients about BDO Lead and the tool, the first question I ask them, have you decided on a transitional method? Because these three transitional methods have hugely different impacts on your numbers, as well as complexity on finding information. So in the standard, they talk about full retrospective and modified retrospective, but I want to flag that modified retrospective have two alternatives in it. So full retrospective is a huge job. I'm just putting it out there. You have to go back to the earliest comparative period, but you actually have to go back and capture the information from all your leases that still exist at the earliest comparative period. And you have to go back right to when did the lease start, when did it end, what options did you execute. You have to redo all that information, and then you have to disclose it in the current year and the comparative year. So the information gathering required for full retrospective method is huge. You will get comparable information. If that's what you're after, and that's important for you, might be a good thing to do. We can talk about that. Modified retrospective is where you just go back to the beginning of the current period and you calculate the numbers and you make an adjustment at the beginning of the current year. So you will say 1 January 2019, debit, credit, etc. The two alternatives is actually important. So I would actually strongly recommend you to do modified retrospective just for the cost and the effort involved in full retrospective when you look at 16. And then with the modified retrospective, sorry, full retrospective, it's the normal calculations. You have to go through all these motions to come up with the lease liability. The lease liability is then the starting point to add all these other things to get to the right of use asset. If you do modified retrospective method 1, and by the way, this is the method that each and every client that I've spoken to date wants to adopt, and I get it because it's the easiest, simplest one. And there's another kicker. It doesn't put through any adjustment to your retained earnings on the date of initial application. So if you want to maintain your retained earnings at the date of initial application, this is the one. It's a simple calculation. It's got some downfall in that it pushes your expense to the future. So it depends what's important for you. Do you mind about adjusting opening retained earnings on day one, or do you worry about your expenses in future? But from a simplicity perspective, all you do here is you say, let's calculate my lease liability at the date of initial application, 1 January 2019. How am I going to do that lease liability calc? I would say, what is the net present value of all future payments? Forget about what happened in the past. Forget about what I paid in the past. Just put in our BDO lead tool future payments, and we do a net present value calc. And then to calculate the right of use asset on the 1st of January 2019, you just say, let's add prepayment or deduct accrual, and that will give us the right of use asset. So we're not going to go back and worry about initial direct costs and all kinds of other nonsense. We're just going to say, let's go forward. Lease liability, less the accrual at that date is my right of use asset. Off we go. We now repay this lease liability, and we depreciate this right of use asset. So this is very simple. The modified retrospective method number 2 is you measure at the date of initial application your lease liability. So 1 January 2019, what are my future payments discounted back? This is my liability. But then you still go and say, okay, this is my lease liability, but let's look at initial direct costs. Let's look at cost to restore, remove. Let's look at payments made at or before commencement date. Let's deduct lease incentives, and then we come up with our right of use asset. So this is a big exercise again. To get to that right of use asset. It will give you a more accurate right of use asset, more effort. But those are the 3 methods. So it's important that you decide which of those you want to follow. It's also important that there are certain practical expedients available. So do you want to reassess whether you have a lease or not? You can decide. Most people say we don't want to revisit that decision. And if you use the modified retrospective approach, so the 2 modified retrospective alternatives, there are also 5 practical expedients that you can decide to use or not use. You can use all, you can ignore them, just as you want. So running out of time, I would say the following. Next steps, very high level. On AASB 15 and 1058, which I've grouped together, because it's around income recognition. Do you receive government grants? What other funding do you receive? If you're a school, what are you doing with application fees, enrollment fees? Again, that is another thing that's currently at the AASB staff. We've submitted it around what we think, waiting for them to respond, very judgmental. But what income streams do you have? Do you know how many contracts you have? Do you know whether they're similar or different? Do you have a process to analyze those? And if you look at leases, and I'm looking at 16 and peppercorn leases, do you have copies of all your leases? Do you have all the data that we need to do the AASB 16 calculations? Do you have a technology solution? I should say the technology, yes. The technology solution is something that for independence reasons we cannot sell to BDO audit clients. There's an independence conflict there. Next steps, and I've asked these questions at the start. Have you educated yourself on these standards? Have you done a risk assessment? Do you know how many contracts you have, what the standard will mean to them? Have you decided on a response? Do you have a project plan? Have you picked a transitional approach? Do you understand the benefits and disadvantages of each transitional approach? Have you decided on how you're going to change your systems and processes? And I think these are the key takeaways, really. If you need assistance, as I said, the AASB and BDO have worked on frequently asked questions, and I've given you the link here to the AASB website where you can see AASB staff frequently asked questions developed together with BDO Australia. There are 5 as a start. There's a lot more to come, so keep an eye open for those. Also, we do monthly financial reporting webinars, and with these standards, although they're not tagged not for profit, to get a general understanding of 15, 16, there you can see the webinars that we've done in 2018 so far, the ones remaining. Those are just videos that I record to tell you what's in the webinar. It's like an ad, and you click on watch to look at the recordings. And there's also the webinars in 2017. And if you click on watch, there's also a place to download the actual PowerPoint slides. So if you want to go there and say, I want to watch the webinar, but I want to download the presentation, you can also get the PowerPoint slides. So that's resources available to you free of charge, obviously. We also have newsletters and other publications. So for instance, we've got monthly newsletters. You can ask me to, or you can just say, can I please join your distribution list? We send out all our newsletters. But also here, if you look at IFRS in practice, you can see we've got documents, publications on these new standards. And the IFRS 16.1 was updated in February this year, and it's got a specific section on the 3 transitional approaches, benefits, disadvantages, etc. So great amount of information available. If you go on our website, and I've given you some links here. If you want to speak to somebody about technical advice, I'm looking after Melbourne and National. Wayne Basford is in Perth, and he's assisted by Susan Altmeadow Hall. Clark Gerald based in Brisbane, and Kevin Frobers, who also did a webinar earlier, is based in Sydney. But please feel free to contact us, or if you want to contact me, and I can direct you in the right area. Our teams, we're very blessed at BDO that we've got a lot of people in IFRS advisory. These are the Australian people, and I just realized that I've excluded 2 people that joined last Monday, so 2 new recruits. And we also have 4 colleagues in New Zealand. So we work very closely together to solve these practical problems. Any questions? Please put it in the chat box. I'm sorry I've run out of time. So if you've got questions, please put them in the chat box. Please email me. My name is just aletta.bossoff@bdo.com.au. You can search me on LinkedIn, on our website. Please, connect with me on LinkedIn. I often post videos, etc., newsletters, articles on LinkedIn. I would like to say thank you very much for joining me today. I hope you found it informative, that you've learned a few things, and that we speak soon. Thank you very much.